how does this interact with pensions? So a number of you in the room came to a really interesting seminar that we ran last year on the Pensions Freedom Act. So that was kindly hosted by ourselves with Rob Lallo of Tudor Court, who's on the front row tonight. Wave, Rob. Okay. So Rob is a financial advisor, and Rob is an individual that we refer clients to for things such as pension advice, because we can't give advice. We're not financial advisors. We can't do that. So for any of you in the room that are currently paying a pension out of your net income, rather than paying that as a company expense, an employer's deduction, please can you stop that now? Okay, that is the most tax inefficient way of doing things, has been for a while, but it's particularly relevant now with dividend tax. So we can shift our profits into a pension scheme by the company paying an employer's contribution, hence reducing our profits and hence reducing our corporation tax. Obviously, we're not taking that income out privately, so we also don't pay dividend tax. So all of the things that we learnt last year on the Pensions Freedom Act still apply if the employer, the company, make the contribution, or if we make that contribution personally. We have a cap per annum of £40,000 that we can pay into our pension. There's various carryback rules and things that Rob talks about. But what we are seeing and what we're beginning to be asked about by our clients is paying lump sums into pensions, because we can withdraw from our pension at the age of 55, depending on your circumstances and your retirement plans, a complete win-win situation to avoid dividend tax altogether. It does mean that you have to tie your money up into a pension, so it's a personal point and it's something to discuss with a financial advisor. This is particularly relevant, in my opinion, if you're reaching the age of 55, because at 55, we have lots of flexibility with withdrawing the money that we've just put into our pension. So I have a really simple brain when it comes to pensions. They're not something that I particularly enjoy, as many of you know. But in your pack, what I've done is I've just given a simple example of how I think pensions work and what the benefits are. So I have £30,000 spare in my company. I don't actually really have a need for it personally. It's sloshing around in my company. But I'd like to do something more tax efficient with it, potentially, than either leaving it sitting there doing nothing or taking that money out to put into my personal savings account and having all of this dividend tax to pay on it. If I paid that £30,000 as an employer contribution into a pension, I save corporation tax of £6,000, 20%. If I was to take that money as a dividend, and I was a higher rate taxpayer, which I would be by the £30,000, wouldn't I? I'd be paying personal tax of £9,750. I'd actually only get just over 20k of that 30k. So I pay my money into my pension, and I get to the age of 55 and I stop trading. But I'm not going to have any other sources of income. So I go and see Rob and I say, that £30,000 that I put into my pension, what's it worth today? He hopefully says more than 30k, but for my simple brain, he says 30k. I'm 55 years old. I can take 25% of that money tax-free. That's always been the rules. They're not here to change. I've got my personal allowance to use that year. So I could take another, say in today's rules, £11,000 of that 30k out of my pension pot, and that would be free of tax. On the balance, 12.5k, if tax rates are the same as they are today, I'd pay 20% tax on that pension income. So I've put £30,000 into my company pension. I've saved £6,000 corporation tax in 2016. And when I'm 55, which I don't actually know which year it is, which is a bit scary, I go along to Rob and I extract my £30,000 that's been safely put into my pension scheme. I can actually take that money out if my circumstances are right and actually have £27,700 of that in my pocket. That's a little bit different to paying a dividend today and having £20,250 of that in my pocket, remembering I've also saved my corporation tax of 6k. I think that's probably as far as I'm allowed to go when it comes to advice, thoughts and views. As I say, Rob's details are in our pack as Appendix A. Many of you know Rob from the talks that he's done for us before. Rob will be around after if you'd like to catch up with him. What else could be happening in my company that I perhaps need to think differently about? So the company owes me money. As a shareholder, I've given the company some money. I actually rarely encourage you to charge interest on that. I say it as paperwork for paperwork's sake. I save corporation tax at 20% on the interest charged back to myself, and I pay 20% personal tax on taking that money out of the company as interest. Seems a lot of paperwork for no reason. So I gave a little bit of thought as to whether there was something better to do, and I've used a case study in your notes as an example. So I have £100,000 that the company owes me. Say I charge 6% interest. The company has an expense in its profit and loss account of £6,000, so it saves me £1,000 in corporation tax. The alternative is well, I'd just have an extra £5,000 to take out of the company as a dividend, wouldn't I? So going forward, should I charge interest on that loan or should I make a dividend declaration? Well, the conclusion, if we look at the table, is, well, as a basic rate taxpayer, I would charge the interest on the loan. As a higher rate taxpayer, there's actually no difference which route I go down, either charging the interest or taking a dividend. If we're in a situation that the company owes you a significant amount of money, please speak to us over the coming weeks about perhaps putting a loan agreement in place with a fixed rate of interest so we can look at this in more detail on a one-to-one basis. Whilst we talk about loan accounts, is there any opportunity of looking at loans in the opposite direction? We're two separate legal entities. I have a company called Coalesco Accountants Limited, and I'm called Linda Frier. There is the opportunity for the company to loan me money. Now, there are certain rules in company law. That means I can do this or I can't do this. In the way that any companies have been set up, that law or I have incorporated, we can do this. We need to have a look at the rules of your own company's articles of association if this is an option that you're looking at doing. So everybody thinks a director's loan account comes with lots of paperwork, lots of additional tax, and is illegal. Actually, there's a huge tax planning opportunity here, certainly for the higher rate taxpayer, or somebody that's going to become a higher rate taxpayer if they need a bit of extra money from their company. So when a director is made a loan from the company and that loan remains outstanding 9 months after the company's year end, the company will be required to pay this really strange tax called Section 455 corporation tax. Section 455 corporation tax is 25% of the loan outstanding. And I have to pay my Section 455 tax on the same date as my corporation tax is due, so 9 months and 1 day after my year end. However, when I repay that loan, if I choose to repay that loan, my Section 455 tax is refundable back from HMRC. So let's have a look at the case study in our notes. I'm taking a loan of £10,000 from my company. That is the maximum I can take without me getting really jittery, okay? So I take £10,000 from the company, and up to £10,000, I can take that interest-free. I don't even have to pay my company interest for that money. So I've had the loan for more than 9 months after my accounting year-end date. So I have to pay across to HMRC 9 months and 1 day later, £2,500 in Section 455 tax. If I needed that £10,000 from my company and I was a basic rate taxpayer, I'd have to pay them £811 in tax. If I was a higher rate taxpayer, I'd have to pay them £4,815 in tax. And those two taxes are money that I'm never going to see again, and I'm never going to get them back. But remember, if I repay that loan, my Section 455 tax is repayable back to the company. So this method of extraction actually helps my cash flow in the first instance, if I'm a higher rate taxpayer, because the tax I pay is less. If I do need it short term, and I do make the repayment, my company gets its tax back anyway. If I want it longer term, I've still paid less tax than I would have done at 32.5% dividend tax. I'm sure you would agree. Just a couple of notes of caveat. This loan does show on the balance sheet of the company. It is included in the notes. So if you're from a regulated body or you're from an area where people ask to see your accounts on a frequent basis, they may wonder why you're borrowing money from your own company. Those notes do actually have to be in the abbreviated accounts, so the ones that are now free from Companies House. This is a huge way of saving tax as a higher rate taxpayer. I can do the £10,000 once. It's only once, it's not per year. But that £10,000 is available to anybody that's a director. So for those of you who have 2 directors in your companies, that's £20,000. For those of you who have a spouse or a friend or a mother that you want to be able to give £10,000 to, then you can appoint those as a director, of course. They don't have any ownership in your business, because remember, shareholders and directors are different people, aren't they? Directors are just an officer with a responsibility. What an opportunity that provides. So, whilst we're talking about adding people, well, what else would I might like to do to help me save tax? Well, the question that's posed, I guess, is, do I make my spouse a shareholder in my company? Or if I have a dependent, either a child or an elderly mother that you care for, what can I do by making them a shareholder that saves me tax? Well, let's keep it simple to start with, and we're going to build up. So think about the fact that we all have this new £5,000 nil rate band. So my mum doesn't have a share to her name in anything, okay? So if I was to issue, going back to slide 2, a Class B share to my mum, she can have a dividend from my company of £5,000, use up her nil rate band. She wouldn't pay any tax on that, would she? My mum's an employee of my company. We use her a bit of a tax dodge as it is. She's going to be used as an even greater one now. That £5,000 goes into my mum's bank account. But if that's replaced in salary, on which I'm paying employers' national insurance contributions, and after all, she's receiving £5,000 free of tax, that's really exciting, isn't it? Now, can I do that? Potentially not. But if I was married and I had a spouse, yes, I could. So if I take Peter as an example, his wife Kate isn't a shareholder of his company. But if we were to issue a share to Kate, then that's his spouse. So what's the difference? Well, the difference is that my company might be worth a couple of quid. And if I issue shares to my mum, I'm gifting her something that is a capital gain, where she's paying nil proceeds for that gain. And therefore, that gives rise to a capital gains tax liability, which I, as the business owner, are responsible for. Okay? The problem that we have with doing that is I may argue that my business is worth £2 and the revenue might argue that it's worth £2,000, maybe a couple of 100k. Okay? What happens every time we do a share issue to somebody who is a non-spouse is we have to get a professional valuation of our company, and they cost a fortune because anybody milks any opportunity like that from a legal point of view. So let's just go back and have a think about this. If I was married and I issued a Class B share, as Peter is going to his wife Kate, then,
Don't tell it though, will you?
then as we remembered from slide B, is we can specify what rights that Class B share has. So Kate won't have any voting rights within the company. So you'll be pleased to hear. Okay. But by paying Kate £5,000 a year, she isn't going to pay any tax on that. But Peter, if he took that £5,000 out of the company, would either pay 7.5% tax, costing him £375, or if he's a higher rate taxpayer, it would cost him £1,625. So one share issue of a Class B share to Kate has just saved Peter either £375 or £1,625. The reason we can do that is between spouses, there is no capital gains tax payable. It's a nil rate transfer. Okay, that's spouse or civil partner. So you'd think at that point that Peter was probably going to add 3 of his children as shareholders. But remember, we can't do that because we're then giving them part of the value of Peter's business, and that will trigger all sorts of professional valuations and capital gains tax liabilities. And HMRC are undoubtedly going to argue every one of these until we all give up. Okay? So that's idea number 1, and that's why we talked about share classes. If that's something of interest to you, please let us know. We have some lovely template documents, and we charge £50 plus VAT to do that piece of work for Peter. We can do it for any of you. Okay, so I carried on thinking about shares and share classes just between spouses because nothing else really excites me. So we are then in a position where we need to think about having our spouse as a shareholder and potentially paying them more than £5,000 a year as a dividend. And the reason that we would do that is, of course, we have these different rates of tax payable on dividends. So if I was taking a dividend, as per our case study, of £40,000 from my company, I take my £11,000 salary, I'm going to pay tax of £4,625. There's going to be that top slice at 32.5%. If I had an ordinary B shareholder as my wife or my husband, and I took 20k and he or she took 20k, even if my spouse went to work and had a salary of £24,000 per annum, the marginal rate of tax in our household would actually decrease. And we can see there on the £40,000 row that through working through those calculations, with my spouse, with her £24,000 a year salary, I save tax of £2,125 just by extracting that dividend in a little bit more of a clever way than I've ever bothered doing because I've never paid tax on my dividends. A few marriage proposals? It is a leap year. Okay. So, if you're looking to set up a new company, I think most of us here have got a company, but right here, right now, if I was to start Coalesco Hotels Limited, my mum would be an ordinary B shareholder, undoubtedly. My dad would be an ordinary C shareholder. I might even let Laura have an ordinary D share and another employee have an ordinary E share. And the reason I would do that is actually on that first day of incorporation, does my company have any worth? Probably not. So actually, when we're incorporating going forward, we should have all and sundry in that company, shouldn't we? Because nobody can argue that we've given anything away because there was nothing to give on day one, was there? Okay? Remember, because of all those people having different share classes, we don't have to pay them a dividend. We might choose never to pay them a dividend, but we've got the option, and we've got the option from day one. Lots of closings of business and the opening of new names next week, I see.